With the details. The meeting is today, and we'll keep getting you an update of that. But for now, we're joined by Aditya Sood, who's the fund manager of InCred Asset Management, to weigh in on the markets. Hi, Aditya. Good afternoon to you, and thank you so much for joining us today. Aditya, just look at the way the markets are playing out right now. We are trading in a range right now because we are still undecided on how the tariffs are likely to play out and what is going to be the impact. We still have the 25th August meeting that's going to take place. But one thing is very clear, that it's really the domestic players, the domestic economy that will shape the future of Indian markets, and therefore earnings are going to be a big positive trigger. Till now, how have the earnings shaped up for you? And come second half, how do you see the earnings play out?
Yeah, so as you rightly mentioned, I think so earnings are very, very critical. And the backdrop being that essentially, if you look at step back and think about the COVID low, ever since the COVID low, we had 25% CAGR in earnings getting delivered from 2020 to 2024. If you look at the long-term earnings trajectory, possibly, it is like a 12% CAGR in terms of earnings growth, which is a combination of GDP growth and inflation, which is nominal GDP growth. So we do believe that we are in a mean reverting environment. Last year, on account of elections, state, center, earnings fell off the cliff. Nobody was expecting that the earnings growth is going to be in that 5% sort of a vicinity. So our belief is that we would be in a 10 to 12% earnings growth trajectory. Although having said that, there are certain elements which are very, very critical. The first one being credit growth. So credit growth clearly needs to pick up. The liquidity is abundant at this point in time, but we do see a lack of fiscal impulse by the corporates in the sense that we don't see too much of capex happening. But I think so the environment is very, very conducive. If you look at India's positioning in terms of today the risk-free rate has virtually collapsed. If you look at the bond yield differential between India and US, that leads me to believe that India's premium within the emerging market has already shrunk massively. So I think so we are in a very, very good environment as far as expansion of PE multiples are concerned. In last 1 year, more importantly, the index has not gone anywhere. 1 year return on a rolling basis is zero. So we do believe that this is a very conducive environment. Second half is going to be materially better in our view in terms of earnings growth, essentially because of the base impact of earnings as well.
Absolutely. Aditya, hi, good afternoon. Mansi this side. There's so much happening on the global as well as the domestic front. There is tariff uncertainty. We see the FIs constantly selling in the domestic markets. At the same time, the earnings season, not that great as we expected, at least the first half. And at the same time, as we see the triggers or the positive triggers of the market are missing. The only ray of hope right now is the festival season which has started, which will kickstart, of course, with Raksha Bandhan, and then it will go for the second half till December. Do you see consumption basket playing around or festival-related seasonality factor spaces playing around? What are the favorable sectors on your radar?
So Mansi, one has to take a view, slightly, 1.5 or 2 year view. And if you have to break the consumption story, post-COVID, we saw urban consumption really doing very well. And, one of the elements was mean reversion. For example, in a category like cars, basically, or upgrade in terms of, two-wheelers, we clearly saw that playing out. If you look at the rural consumption story, it is directly correlated to income. And let's not forget that we have seen with gold prices going up. I'm a big believer that, rural consumption will rebound very, very strongly on account of two factors. One is that, there is a bit of a balance sheet repair which has gone through, because in a $4.5 trillion economy, we have got $2.5 trillion of gold holding. So if gold goes up by 45% in a year, obviously it helps in terms of balance sheet repair. So that is point number one. Point number two is that two things are happening on the consumption basket. One is that low unit consumption, which logically should do well. There are a lot of people who have upgraded from bottom of the pyramid and they are just above the poverty line. So we are very, very constructive on low unit consumption categories.
Right.
And then there is an additional trigger of pay commission, which is going to come through. In our view, this is going to have a 1% positive impact on GDP for the next year. And in pay commission, if you go and see how consumer categories do in the sixth and seventh pay commission, they always do well.
Agreed.
Obviously, one has to take it with a pinch of salt in the sense that, the number of employees on account of headcount of VRS, so on and so forth, has gone down. It is not as large an impact, as it used to be in the past, but still 1% of GDP is not a small impact. So our view is that, there are.
Okay. Aditya, yes, there's paucity of time, but then we have gathered a lot of views coming in for the market at present, and thank you so much for helping us with the fundamental aspect of the market. These insights are quite important at present for us. Thank you, Aditya. We're slipping into a short break. We'll be right back.